Saving up and helping kids or grandkids with college is one of the most important and biggest financial goals. However, it's extremely difficult to invest for college. I'll explain that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so it makes sense to discuss during a volatile year in the markets. That's when I'm recording this, 2022. Stock market's down roughly 20% year to date. However, it's just easier to see right now. These risks have always been present. And what risks am I talking about? When you're looking at your big financial goals out there, most people have a financial goal of buying a certain house or buying a house, period, okay, and maybe paying it off, right? Second big one is maybe even the biggest, and that is retiring someday, being able to step away from that paycheck confidently, transition onto Social Security and income off of your investments or from other sources, and still have the same lifestyle that you had before. The third most important or biggest that's not shared by everyone, but it's still very common, and that is helping kids or grandkids with college. So it's an enormous goal, takes a long time to save up for, and very difficult to do, okay? However, you can do it with proper planning. When you're investing your way there as you're saving up for college, the investment decisions, it's much more difficult. Investing for this college goal is very, very challenging. You can overcome it, but you've got to be aware of these difficulties. The first is that there's not much time to save up for college, okay? There's not much time to save up for college. If the formula for building wealth is wealth equals cash times risk times time, how much cash can you contribute towards it? How much risk are you willing to take? And how much time will you give it to grow? Okay, that's the basic formula for building wealth. Well, when you're saving up for retirement, hopefully you're saving up for 40 years, okay? 35, 40 years, you've got a long time that you're gonna be saving up. Well, if you started as soon as you possibly could, the maximum amount of time that you can save up for college is 18 years. And maybe it was so clear that you wanted to help your kids with college that you started saving before they were even born. That's extremely rare. I hear that from time to time. Rarely do people actually do it. Oftentimes, you're not starting to save for college until they're a little bit older, okay? Because when you have that child, that's a very challenging financial time, okay? I've done some videos on that before. You've got new expenses, you have changes in income. That's a hard time to start a new savings, okay? I would encourage you to do so, and absolutely you can and you should. That's likely the time that you're most motivated to save up for their education is right when they're born. However, financially, for many people, it's difficult to do. And so the maximum amount of time you have to save up for college is 18 years. Most people maybe save up for 10 years, 12 years. That's not a lot of time to save up for such a big goal. That's the first challenge. The second challenge is then college only lasts 4 years. You're gonna spend this money in just 4 years' time. Think about this, okay? When you're investing, and this goes back to that wealth building formula of wealth equals cash times risk times time. Now this speaks to the risk, okay? Even though I'm talking about you're gonna spend this money only over 4 years. What if your retirement lasted only 4 years? How would you invest that money, right? So typically, traditional thinking, and I'm just gonna make it more simple than it actually is, any money that you're not gonna touch for 10 years or more is long-term money. Go ahead and be a little more aggressive with those dollars, 10 years plus, okay? As soon as you need the money within 10 years, you've got to start reducing the amount of risk that you're willing to take, okay? Because you've got to lessen the chance that you're going to need to access this money when the stock market suddenly drops like we're seeing right now. Anytime you need to withdraw the money within 2 or 3 years, you shouldn't really be taking much investment risk at all. College is 4 years. I mean, think about this. If that's the case, you need to start reducing the amount of risk that you're taking when your child is 8. Most people haven't even started saving up for college at that time, and if they have, they don't have much saved up. And based on that conventional thinking that we apply towards saving or investing risk for retirement, you should start reducing risk when that child is 8 years old. And by the time they're a senior in high school, you should really be taking no risk at all because you're going to need this money over a short period of time, okay? Those aren't recommendations. I'm just pointing out investing for college is tricky because you don't have as much time to save up, and then you're going to spend that money over just a short window. So realistically, you do need to start managing that risk and lowering that risk when they get into middle school and reducing it significantly when they get into high school. Thinking through, okay, are stock valuations high, are they low, and having that influence how much risk that you're taking. And then the third reason why investing for that college goal is more difficult than most people realize is the most common type of account that you're going to save up for college is a 529 plan. Had a newer employee ask recently, hey, I'm studying about these Coverdell or educational IRAs. Why haven't I ever seen them? It's because the 529 plan is superior in many, many ways, okay? I've done some videos on that before, but the 529 plan also has some drawbacks, and one of them is you are limited in how frequently you can change your investments. That's right. In an account, think about this, it's counterintuitive. In an account where you're saving up for a certain goal, where you don't have as much time to save up and you're going to spend the money over a very short period of time. By the way, 529 plans you can now access for education outside of college, other than college. So earlier than college, you might even have a shorter amount of time to save up and even a shorter window in which you're going to be spending this money. But in an account that's structured where you're going to need to make your changes to investments pretty frequently, you're limited, you're restricted in how many changes you can make. When I started in my career, you could only make one investment change to your 529 plan a year. Now it's twice in a calendar year. Still, that's not a lot of time. And I'm not going to argue, well, you should be trading in your 529 plan. Absolutely not. And so you shouldn't be threatened by this, make 2 changes a year. But think about it. Think about this. The stock market's doing just fine, and your child is a sophomore, okay? And so you're taking more risk, thinking, well, at some point I'm going to need to dial this down. But they're a sophomore in high school. I still got a couple years. That's fine. And then all of a sudden, you sit down with your certified financial planner and they say, gosh, valuations in the stock market are pretty high. Should we tamp this risk down a little bit? And you say, well, I don't want to do it too much. I'm okay with it, but I don't want to take, I don't want to be too conservative because the market's been so good. Okay, so you rebalance down to a more conservative mix, but just slightly. And then all of a sudden, the bottom drops out of the market, and we see a 20% decline in just a couple of months. And you say, oh my goodness, and this thing might not come back by the time we need this money. Now let's really ratchet the risk down. Well, those are your 2 investment changes, just like that. And if you make a third, then you negate all tax benefits and tax sheltering that this 529 plan has to offer. You're limited on how frequently you can make changes to your investments. And if you're not aware of that, seeing times like we're going through right now, you can say, oh, I want to move it all into cash, or I want to move half into cash, and then I want to move more into cash. Oh, now I want to move it back into the investment. I'm not suggesting you should do that. I'm saying not being aware of this restriction, this limitation, could cause you to make a significant blunder that creates a lot more tax than you should have. There are more investment challenges with investing for college. Limited investment choices. Should you use target date funds or pick your own? Those are things you should work with your certified financial planner on, especially these 3. But saving for college, likely if it's a goal of yours, it's going to be one of the biggest financial goals that you have, okay? And investing your way there is part of the process, but it's more challenging than it is for investing for other goals. Work with your certified financial planner. They can help you run the numbers to see how much you need to be saving and how much potential investment growth should you have, and therefore how much risk should you take in your investments. What's the right strategy for that college goal? Work with your CFP on that. If you don't have a CFP on your team, you can contact one of my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.